Welcome to Tasty Trade's Option Strategy Series. In this episode, we will go over the covered put, which is known as an income-producing strategy for a short stock or ETF position. Let's start with the basics. What is a covered put? A covered put can generate income by selling a put option against 100 short shares of stock or ETF. The put is typically sold at a strike price below the stock's current market price, which is also known as selling a put out of the money. This is done to increase the trade's maximum profit potential and reduce the risk of assignment. However, this doesn't guarantee your short put will remain unassigned. If a short put faces early assignment or is assigned upon expiration, each assigned short put option has an obligation to purchase 100 shares at the option's strike price. This is where the covered put gets its name. Holding 100 short shares offsets or covers the potential short put's assignment obligation. Unlike a long stock position, which benefits from an increase in price, investors with a short stock position benefit when the price of the shares fall. When selling a put against 100 short shares, an investor is capping their downside profit potential below the put's strike price in exchange for the credit received from the short put. By doing so, selling covered puts can help hedge against potential price increases. However, potential losses are still unlimited if the price of XYZ were to continue increasing. Now that we understand the basics of a covered put, let's take a look at some hypothetical scenarios. Suppose an investor holds 100 short shares of XYZ stock priced at $100 a share. The investor expects the price of XYZ to decrease, but wants some added upside protection in case they're wrong. The investor decides to sell a 95 strike put option against their XYZ short stock position and collects $300 in premium. By selling the 95 strike put, the investor's profit potential on the short shares is capped when XYZ's price decreases to $95 or lower. Additionally, by selling the put for $300, the entire position's break-even point at expiration is now $103. However, potential losses are still infinite. Now, depending on the stock's performance, a few different scenarios may play out. First, assuming the put option sold against your short stock remains below the stock price or out of the money for the lifetime of the put option, the value of the put option sold may erode each day to potentially yield a profit if the position is closed before the option's expiration. If the short put is not closed and expires out of the money, say XYZ expires at a price of $105, for example, the short put is unlikely to be assigned. The option is then considered worthless, and the investor realizes the $300 premium collected upfront as profit. However, due to the upward movement in XYZ, the short stock position will suffer a $500 unrealized loss. The $300 premium received for selling the put will help offset those losses, though, resulting in a net loss of $200. On the other hand, if XYZ's price falls below the 95 strike to a price of $90 at expiration, the in-the-money option will likely be assigned if held through expiration. And the 100 short shares will be bought back or closed at $95 per share. In this scenario, the investor's short shares profit $500 from the downward move in XYZ from $100 to $95, where the profit on the short shares are capped. The investor also benefits from the $300 in premium collected from selling the short put, resulting in a total max profit of $800, excluding any commissions or fees. While selling the covered puts may generate income, there are some risks to consider as well. There is always the risk that the stock price continues to increase, which could help yield a profit on the short put alone, but the profit made on the short put may not cover the potentially unlimited losses from the short shares. Additionally, if an investor sells a covered put at a strike price above the short share's cost basis, it could result in locked-in losses. Lastly, it's important to note that investors shorting or borrowing shares may be charged a hard-to-borrow fee each day those short shares are held. Also, if the investor is short a stock that pays a dividend, then they may also owe the dividend too, also known as dividend risk. In any case, a covered put can be a viable strategy to potentially generate income on a short stock position in exchange for capping the downside profit potential. Looking to place a covered put on the desktop platform? Check out our tutorial videos here.